Yeah. Surprise, a little different than you used to. Yeah. Dropping these bars on YouTube, knowledge I introduce you. Yeah. We chasing this money like it's the prize, it's the voodoo. Fugazi, fugazi, it's just a lie we buying into. We need some cars on deck. Get the rollies, get the moe, all the Mars on deck. All right, good afternoon. Thank you so much for joining me. There was a comment yesterday which has kind of triggered this video today. So I thought we'd talk a little bit about savings rates and how you can hopefully get the best out of savings rates right now to kind of help you combat inflation. Now, obviously, with the title of this, I think it's important for us to have the conversation around the fact that the savings rates currently are not going to help you beat inflation. However, they are going to help you make your money work as hard as possible. And there are some caveats as well. Clearly, as interest rates are flexible, they're likely to increase. Some are saying, if you believe the commentary from yesterday, by another 1.5%. What we talk about today is likely going to change. So please just bear that in mind. But I'm just going to go through maybe some things that will help you, some accounts that I found online, and I'm going to be talking about them through different account categories. So I'm going to be looking at instant access accounts, I'll have a look at notice accounts, and I'll also have a look at fixed term accounts or fixed rate accounts, basically. So 3 categories. What are the best in class for each of those? Before we begin, I say this at the top of every single live because it is really, really important, and it is a bit of housekeeping now. But if you do find value in this, please make sure that you tap the like button. It takes a second for you to do that, but it means that YouTube will look at this video after it's gone live. And if people interact and have engaged with it, they've liked the content, they've shown that they've liked the content, then they will recommend it to other people like you who may also benefit from this. So it does take 1 second to do, but it really does help the channel. And if you haven't already subscribed, please consider subscribing. Yesterday, we were 10 away from 800. We're now at 820. So thank you so much to everyone who subscribed in the last day or so. I really, really do appreciate it. All right, so I've had to restart my computer, and it's a miracle that I actually started on time, but I do need to share my screen with you. Now, let's just recap, because I think it's important for us to recap just so we can get an idea of where we basically are and what's going on at any given time. You know, inflation at this point is 8.7%. So at the moment, from what I've seen, what I've been able to research today, there are no interest rates currently available at that level. So when I go through the instant access, the notice accounts and the fixed rate accounts, you're going to notice that. I also do want to talk a little bit about regular savers, because I kind of made a comment, I think it was maybe day before yesterday or earlier this week, about the fact that regular savers work very, very different to normal savings account. And I actually ran a calculation to compare if you were offered, say, a 7% regular saver and a 4.63 or something like that on a normal savings account, which one actually works out better. I'll come to that a bit later on. So let's have a look at, first and foremost, let me make sure I've got my tabs all in order. Let's actually start with the best cash ISA that I've been able to find. Now, look, you can do this on your own. This is on money.co.uk that I've been searching this here. So I'm just going to share my screen here so you can see what I'm looking at. Share this tab instead. And let's go over here. Where are we? What's going on? Oh, that's better. There we go. All right. So the highest cash ISA. Now, why am I talking about cash ISAs first? Obviously, with the cash ISA, it's tax-free. So you've got your £20,000 allowance, which you can throw into that. And if you do get a good interest rate, so the highest interest rate available here, bearing in mind, it is not instant access. You're locking this in for 1 year. It's 5.1%. But that is all completely tax-free. So in the example where you are able to perhaps max out your full £20,000 allowance at 5.1%, you'll be looking at just over £1,000 in the return. So not to be sniffed at, but it is tax-free. But this is the highest one with Aldermore at the moment that we can actually find. In fact, most of these, I mean, the next one is 4.7%. Most of these are all fixed rate ISAs. So they are fixed for a 1 year period. This is an e-ISA from the Yorkshire Building Society. That's 5.1 as well. Yeah, until 31st of August 2024, this is going to be available for, you got to open with £100. So go and check these out. But this is the highest that I found on the fixed rate ISA element. And I would encourage you again, actually look at this one. This is Leeds, 5.5% available. So actually slightly more than the Aldermore one that is available here. Let me just scroll down to see what else we got. We got 5.15 here, but now you're getting into longer term. So yeah, this is the highest 1 year fixed rate ISA at the moment from Leeds Building Society at 5.5. I thought Aldermore was the highest one at 5.1, but it's not. I wonder if there's much difference between this. You've got to open with £1,000 for that one. This one you can open with £100. This may actually be, sorry, 1 second, make sure I've got the right one. That's 2 year fixed. Went down too much. Yeah, £100. So that one might be more palatable for a lot of people who may not necessarily have £1,000 lying around, 5.5%, which means that on the £20,000, just in case you wanted to do a transfer or something like that, you're looking at 1,100 in a return that you're going to get isn't going to be susceptible to interest rates. And I guess that right there is the beauty of using a fixed rate return. You know what the outcome is going to be 12 months or 24 months from now. Now, obviously, there are 24 months deals on there, but here's my thoughts, right? So bearing in mind, if you watched the video yesterday, we know that there are rumors that there's going to be another 1.5% rate increase probably in the next 6 months. One thing you should be aware of is this. This Leeds one at 5.5% is for 1 year. If you see any interest rate rises between now, so if you open the account today and you saw an interest rate hike in a month's time and interest rates were to move, or you found a new product from Leeds offering a similar term and it went up to 6%, that's it. You're locked in at 5.5%. And this is such that because it's a fixed term, you won't be able to access it until the maturity date. So on this specific one, notice you've got to keep it in there until the 1st of September 2024. So you cannot break this until this specific date right here. Really, really important. And that's what I always say to people when you look at fixed terms. So look, what you get, you're getting a guarantee, which is why the rate is a little bit higher. You're getting a guarantee of the return. But if interest rates move in the meantime, you're not going to be able to benefit from that. And so do I really think it would be worthwhile going for something like an 18-month or a 2-year fixed rate? I mean, the rates aren't really that much more attractive. I mean, if you look at this one at a 2-year fixed rate with Leeds, it's still 5.55%. So to be honest, it's a little bit more, right? But for the extra 0.05%, you're locking it in for an additional year. Is it really worth it? I don't personally think it is, but you may have particular things that you're planning for. You might have something that you want to make sure that you've got money available for 24 months from now, where this could be the perfect account for you. But just bear in mind, things are very, very fluid right now. So if you do lock in, you've got to be sure that you're going to be happy with the rate that's available. I think that's it for the fixed rates at this point in time. Those are cash ISAs. And again, cash ISAs are completely tax-free. The other one that I think is probably worthwhile speaking about, let's have a look at the best ones available for things like notice accounts. Now, if you don't know what notice accounts essentially are, with a notice account, you have to give notice to access the money. Doesn't mean that you can't access it at all. You can. A lot of notice accounts you can actually break the terms of, but it means that you've got to sacrifice interest for the period of notice that you're supposed to give. I'll give you an example, and let's have a look at this one to kind of bring this to life. So the best one that we've got on here is from RCI Bank. Now, I don't know who they are. Don't know where they're from, but the good news here is you still have financial services compensation scheme protection. That's the big thing. If you're trying to put money with a provider right now, they have to have protection on the financial services compensation scheme. Basically means that if the company were to go bust, your money is protected up to £85,000. So this is a must. This is non-negotiable in my book. So the best one at the moment for a 95-day notice account. So in this instance, you have to give 95 days worth of notice to access your account. The rate that they're offering is 4.85%. You've got £1,000 as the minimum opening balance for this. Now, check their terms and conditions if this is right for you and if you like this one, if you do want to open the account. But typically with notice accounts, you can access your money, but it means you're going to lose 90 days, 95 days worth of interest. So what you would do is you would work out, right, I've deposited £1,000 into this account. You times that by 4.85%, divide that by 36, and then you have your daily rate times that daily rate by 95 days. That's how much interest you would lose by breaking or accessing the money in your account without giving the 95-day notice. When interest rates are pretty low, it doesn't really matter. But when you start getting into decent interest rates, sometimes it is worthwhile considering, especially when you also factor in the amount of money you have in there. So if you had £20,000 in there, it would definitely be worthwhile thinking about whether or not it's worthwhile, not giving notice and breaking that. Even if you have £10,000, £5,000, it's all relative, right? But that's how, generally speaking, notice accounts work. Again, with this, you'll get a higher rate because it's locked in for a little bit longer most of the time. And so you're paying a price for that privilege, right? For that additional rate of interest. I'm just going to scan here to see if there's any other outliers here that kind of pop out. There are different terms. I mean, you've got a 120-day notice account here, which is what? That's 4 months. It's a lot. I mean, a lot of people will tend to put maybe things like emergency funds in notice accounts, and I think that's okay. But I think sometimes it can be counterintuitive, especially at 120 days, 95 days. I think a 30-day notice account for an emergency fund actually isn't that bad. I think that could be pretty functional because it's 30 days, and if you did need to access it like really, really urgently, 30 days worth of interest for most people won't be too bad. It will certainly be less than 95 days worth of interest. So you got different accounts here. You got the Investec one there, 4.5%. Yeah, but the highest one at this point in time is the one from RCI Bank at 4.85%. So that's your notice accounts. Let me have a look and see what else we have here. I wanted to also talk about instant access accounts as well, see what's available there. Now, the instant access providers, I've actually covered this on the channel, one of the best offers out there. And I actually think that this is a pretty good rate that's on offer, to be honest. And this is actually from Chip, who I did cover on the account. I want to say this year, but it feels like that might have been too... It couldn't have been this year. Could it have been this year? I don't know. So much has happened. But Chip has got the highest instant access savings account right now at 4.226%. And this is really, really good because there are no penalties that you've got to pay. It's instant access. And I actually spoke, whenever I work with a brand on the channel, whether they sponsor, say, a video, or I do a coverage of whatever they offer, I actually speak to the teams before I actually agree to do anything with them. And I did speak to them about their instant access account. And at the time, we were seeing interest rates kind of like move quite a bit. And one of the reasons why they created the account was to have it so that the minute they see the interest rate hikes from the government, Bank of England, they can then translate that and pass that on via the account as quickly as possible. And just monitoring what they've done a couple of times with interest rates, they are pretty quick to the mark to increase the rates. But this is the best one at the moment that I've been able to find, 4.26% available. You do have the coverage by the Financial Services Compensation Scheme as well. I also did a video for them because they also have a prize draw account. And at the time, the monthly prize draw was like £10,000. The monthly prize draw now, I believe, is 50 grand. But with that account, you don't get an interest rate return per se. For every pound that you have in, it's kind of like national NS&I premium bonds. For every pound that you have in your account, it gives you an entry into the draw. And the draw is now £50,000 a month is what the prize draw is. So for someone who maybe likes, I guess, the odds of a chance, that could also be a really, really good option potentially for you. But just know you're not going to get like a guaranteed or known return from it if you will. There are some other good alternatives here. I mean, Yorkshire Building Society, 4.25%. I mean, you can open this with £1, the same thing as you can do with CHIP. You've got the Financial Services Compensation Scheme coverage. Ford Money, 4.25%. Easy access, again, pretty much the same terms. Paragon, same. Skipton's 4.22. Got RCI at 4.2. You're seeing a lot at that kind of like 4.25, right? I would like to see that we start to get into the region where instant access accounts will be at 4.5%, 5%. I think that would be a good place to be. We haven't been here for a very, very long time in instances like that. But those are your instant access accounts right now. Again, quite a bit away from inflation, but at least it's going to get your money working as hard as you can possibly get it working for you at this point in time. Now, let's talk a little bit about regular savers. Okay, so there are some regular savers that are out here at the moment, which are pretty decent. I'll show you this in a moment, but I think the highest regular saver that I've been able to find today is for 7.5%. 7.5%. That's the highest we've been able to find at the moment. Now, how do regular savers actually work? This is important to understand. A lot of the time, what you'll notice with a regular saver is there is a maximum amount you can pay in per month. So it might be £200 or 250 quid, whatever that might be. There will be a maximum, and you have to pay in on a monthly basis. You can't just deposit a lump sum into this account. And so for maybe people who have a lump sum that they want to pay into account, it's not ideal. But if you're trying to cultivate a savings habit, you're putting money away on a monthly basis, this could be great for you because ultimately you've got a home for it to go to, yielding a pretty decent rate of return. Now, it's important to know, a regular saver works very different to a normal savings account where they say, right, we're going to give you 4.26% return per year. You could literally use the calculator and work out exactly what your return is going to be over that 12-month period if you paid in, say, £2,400 to £200 per month. You'll be able to calculate it beforehand. With a regular saver, it's slightly different. So this one that I found here, which is with, this is on the Martin Lewis's site, by the way, so you can always go and check this out as well. Let's get over here. Skipton Building Society. So I can make this a little bit bigger for you guys. One sec, there we go. So Skipton Building Society, you're looking at 5.7%. The maximum monthly deposit on this is 250 quid. So when you max that out over a 12-month period, you're looking at £3,000 you can pay into this account, right? That's the maximum you can pay in. Penalty-free withdrawals, no. Well, really, you can close it early, but you're going to have penalties essentially if you need to access the money. So that's worthwhile. Again, just read the terms and conditions. So 250 quid maximum, 7.5%. Now, how regular savers basically work is, and it is important to understand, because you're paying in £250 a month every single month for 12 months, by the time you hit your last month, your contribution of £250 is not going to get the full 7%. It's going to get a proportion, a 12th of the 7% or 7.5% on offer. Your first payment on this end, though, when you first start, is going to get the full 7.5%, and it decreases every single month incrementally. Now, I did run some numbers, and I used in this example here. Let me just find it. I used this in example here. What I did is I compared an account that offered a 4.6%, 4.63% known return, a savings, for £2,400 over a 12-month period. That account would have essentially given you an interest rate, I think it's of about £111 in return. So 2,400 times 4.63%, it's about £111 return that you're going to get. Now, if you looked at that same contribution, so £200 per month over 12 months, and you had a regular saver of offering a 7% return, what you'll find is that in your first month where you're getting the full 7%, you're going to get £25.83 in interest. In month 11, you'll get £23.33 in interest. In month 10, it's £20.83. So you're reducing roughly by about £3, I would say, roughly a month in interest that you're losing over that regular saver period. However, you do end up with more of a return on a regular saver in this instance than if you went for something like a 4.63% where you have the known outcome. In the regular saver, the total interest that you will earn will be £148.94 versus the £111 that you would have got in the 4.63% account. So it is about what, 37 quid difference roughly? You'll get £37 more in a regular saver. It's worthwhile noting that because not a lot of people understand that with a regular saver. And I say that and I emphasize that because the number on the regular saver is very, very important. If you're looking at a savings account, which is offering you, say, 4.63%, and the regular saver is only offering, say, 5%, by the time you do the calculation, I would question whether or not that regular saver is the better offer for you. You're probably better in that instance going for the 4.63% savings account. So in other words, on a regular saver, you need to have a markedly better interest rate for you to be better off in terms of the interest that you earn over the course of the account, be it for 12 months or say for 24 months, whatever the term that they provide essentially is. So maybe that's just a little bit of inside kind of like information around it. It can be quite confusing sometimes, but once you understand it, it's pretty easy to get through. Now, like I said, look, this isn't going to beat inflation at this point in time. I mean, we can be hopeful if we start seeing inflation drop and fall back a little bit, and let's just say we get inflation down to the targets that they're saying. I mean, let me just bring this up again, just as a little reminder. We'll see if these forecasts have actually changed as well, because this is something that I've done and we have been tracking on the channel for some time now. And it's always nice to stay abreast of these numbers. It'll be interesting to know, where is the UK? What's going on? Europe, there we go. Okay, here we go. Inflation at the moment is 8.7%. We are at the next CPI check going to be hoping that we're going to see something along the lines of 8.3%. But even if we do hit that mark, there is no guarantee that the Bank of England will say, right, we're going to pause on the interest rate hikes for the time being. So look, we could still see interest rate hikes either way of hitting that mark. But let's just say in green world utopia, everything goes according to plan, and we do start to see some significant drops in inflation. Let's just say we get to these kind of numbers, right? 3.9%. Let's just say we get here, and we still have accounts that are paying 4.36, 5%. Then your money is going to be working really, really hard. Then it's going to be worthwhile because you're going to be beating inflation. But in this current time, where the tables are at this point in time, there isn't an account right now that you're going to be able to open that is going to beat that 8.7% number that we're at the moment. So everything's on. Hopefully, we start to see this number creep down. I guess it's a double-edged sword, right? We want the number to come down, but we also want interest rates to go up. And in order for the inflation number to come down, we need interest rates to go up. So on one hand, you could argue if interest rates go up, it's going to be great for savers, assuming the banks pass it on quickly enough. So yeah, we could end up in a positive territory for savers, potentially. But I think that might be a few months down the line. And please bear that in mind whenever you're selecting your accounts now. Because if we are right and we are due to see another 1.5% interest rate hike, that's going to take us to 6.5%. Where does that mean we'll see savings rates? I think we'll see savings rates for instant access cross the 5% mark at that point, for sure. I think you'll probably see regular savers jump up. You might see an 8% regular saver. This is all conjecture, and I'm throwing things out there. Hopefully they come right. But I do think we'll start to see that translate into savings, which will be good for savers. And so please be mindful of that in your product selection. If you're going for a notice account, if you're going for anything where you're fixed in, so a fixed rate, be mindful. If interest rates move, you're stuck. You can't take advantage. So I think what a lot of people are doing at the moment is they may be using instant access accounts, holding those for a period of time, seeing what happens with interest rates, and then moving the account. And here's another tip. When you open these accounts, make sure you're looking at the terms and conditions, making sure that, even in an instant access account, you haven't got to keep it in there for like 60 days. I haven't seen any instant access accounts that typically do that. but check the fine print anyway, just to be 100% sure. I know that the banks don't necessarily like people jumping around for rates, but we are in that environment right now where you have to kind of keep your wits about you, keep your ear to the ground, and find the best rate that is going to work for you. I think we will see the rates move up more and more and more, but just bear in mind that those are a few tips for you to bear in mind in times like this. I'm just going to have a look at the comments really quickly. Let's see what you guys are saying. I did ask a question in the polls, by the way, guys. Please do let me know. What are the best savings rates that you're seeing at the moment? What are you getting right now? Let's have a look in here. Spencer's asking thoughts on Palantir. I'm not following Palantir, mate, so I can't really say. Someone's saying here that there's a regular saver for 7% with First Direct. Yes, we did see that on the list there. But the one that we've just mentioned, 7.5, is the highest paying one that we've found at this point in time. You're also saying here there's a fixed rate saver for 9 months, 5.45% with Atom Bank. Interesting. Okay. Yeah, Atom is app only. So that's a good shout. Thank you. Agnostic. What's the importance? It's only an empire of dirt. People have become consumed by money. Well, if you don't think money is important, mate, then I don't know how do you pay for things? Money is important. It's the relevance and the importance that you put on it. You know, how important is it in the hierarchy of your own personal finances? But the world is built on money at the end of the day. That's just the reality of it all. The skill that we need to be able to perfect is not making money the most important thing in our existences, in my opinion anyway. What should someone do if they buy a house outright but is willing to wait until 2025 because they are a cheapskate? That's under the there's a heavy assumption that we know what's going to happen in 2025, right? I mean, if you got the money outright, I definitely get the idea that you don't want to overspend on the property, and if you get something cheaper, you'll be able to retain more of your cash. But that's assuming we know what's going to happen in 2025. You know, we could see a market crash right now. Person is indecisive, still waits, thinking it might go down further, but then we see a recovery through 2024, 2025, property prices go up. It's hard. We haven't got a crystal ball. And so I always say to people, like, you know, don't try and predict what's going to happen in the future, because we just don't know at the end of the day. You have to try and make the best decision based on what you know right now. And if you do decide to wait, just be open to the fact that, look, when you get to 2025, the world may be a very, very different place in your favor or against you as well. It's really important to know. Premium bonds percentages are getting better and it's tax-free. Yeah, that's another option that you can actually have a look at as well. What are the rates on premium bonds right now? I wasn't too sure on the rate that they had on offer now. Let's have a quick look at that. NSNI premium bonds. NS and I. What are they doing? What rate have they got? Right. They don't make it easy to find out simple information. I've got to do it this way now. Let's see what they're saying. Even just doing a very simple search right here. What's the interest rate right now? NSI increase. Okay, hang on a second. Here we go. From the 13th. So as of yesterday, NSNI premium bonds are increased but to 5% actually. So bearing in mind they're instant access, we had a look at CHIP being 4.36. That would be a better option if they've increased. That was yesterday did this, increased their rate to 5%. But it is worthwhile remembering that the rate on the NSNI premium bonds is not the rate goes to fund the prize draw. So if you put, say, £10,000 in there, you're not getting 5% on your 10%, your £10,000 deposit. The 5% funds the prize draws. And you can win, £25 a month if you're lucky. I think the maximum prize is £10,000. So whilst on the surface, instant access, premium bonds, 5%, chip, 4.36%. Yeah, the numbers look better on the NS&I premium bond, but it's not a 5% return on your deposit of £10,000 or £1,000 or £2,000. It is 5% funding the draw. And the more money you have in there, the more tickets you have access to, entries you have to give you the chance of winning more. So, yes, premium bonds are great. They're tax free, but it's worthwhile just noting that difference across the two, essentially. Right, let's see what else you guys are saying here. Visual, prepared to wait for rates to max out. I think it is a wait game at the moment. There is something to be said about investing right now, and I haven't really spoken much about investing because I think people are a little bit more panicked about what's going on from their mortgage and just expenses point of view, where a lot of people just aren't looking at investing right now, which is kind of a shame because really right now is if you're in with the right kind of like stocks, if you're in looking at the right kind of things, this is a huge opportunity. And maybe I'll talk a little bit more about that on a live. I have got a couple of things in the pipeline specifically for the investing side of the conversation, but I'm speaking to a few people at the moment to see how we can actually organize something that will be very, very interesting and hopefully get a little bit of traction as well. I'm just scanning through the other comments here. Tandem, someone's saying here that Tandem has a 4.36%. So that will be the same as what I've just highlighted there with Chip. Still seeing notice accounts on the screen. Yeah, we've passed that now. Barclays has a 5% rainy day saver. That's instant access as well. That's pretty good. I didn't see that on the list on any of the searches that we have. Let's have a look at that, Barclays. And again, guys, please use this video as a further resource of doing research for your own. One thing I can't do is I can't check every single provider, every single account. I would be here literally all day. So what I try and do is just do a cursory search of what's available right now and then give you a little bit more information to hopefully help you understand maybe some of the nuances behind it. Please use it as a way of actually, doing your own research. So Oliver's saying here that Monzo has a 3.7% interest rate. Wow. Okay. Emma, you've got some good luck. You've won £600 so far this year in premium bonds, won every single month. That's pretty amazing. That's really, really good. Listen, I would almost be tempted to maybe play the lottery, maybe just a little bit. See if you pick up a winning lottery ticket as well. If you've got that kind of luck on premium bonds, doesn't always translate, I know, but there you go. You've got to play it sometimes. You've got to be in it to win it. Someone's saying it. Can you pay first 6 months up into regular savings account, then basically stop paying in and allocate the rest in a savings account? Can you pay first 6 months into a regular savings account, then basically stop paying in and allocate the rest in a savings account? I mean, I suppose you could, but as I just demonstrated there with the calculation between regular savers and normal savings account, if the regular saving account offer is higher by about a percentage or two than the savings account, by splitting and doing what you're suggesting, you're not going to be off. You're not going to be a better place. You're not going to be in a better place. You wouldn't have earned any higher interest, if that makes any sense. So just thinking about it, if you were to run the numbers, I would expect that if you compare the two scenarios, the two outcomes, you'd be better off and would have earned more money in the regular saver than doing the first 6 months in and then putting the remaining 6 months into a savings account, unless you found a savings account that is with a really, really, really good comparable interest rate to the regular saver. So for example, if you had that regular saver at 7%, interest rates go up and there's a savings account that's going to give you 7%, then potentially you'll be better off there. In my head, that's the way I think of it. Where's the forecast? So the forecast that I generally look at is on tradingeconomics.com. And that's the one that I've been following for the most part of the year. And this is where a lot of the government data basically gets fed into. So it gets updated all the time. And if you want to see what the government is basically thinking and what forecast they're working towards, this is the place to come. Tradingeconomics.com. And you can look at it not just for the UK, you can look at it for a ton of other countries as well. Any country in the world, you can look at it. So you can do a comparison between the UK and the US and how we're performing against those. Obviously, this is a UK dedicated channel. So I don't generally speak too much about what's going on over in the States because it's not really, well, it's not that it's relevant, but I'm UK focused. So yeah, but tradingeconomics.com is a really nice way of seeing what the forecasts are and what the picture is and what we're working towards. Yeah, and it does really give you a nice insight. And for example, if you go into things like inflation rate here, you can actually go back quite a bit into the past, and you can see where the inflation curve has come from. I mean, look at that. If that's pretty nuts. When you look at the inflation rate, look at that, parabolic. It's absolutely mad. It's only just coming down now. And that's why everyone's so scared, because in between this peak here and that trough, that parabolic rise, that's where people get hurt. That's where people get squeezed. That's where people lose houses. If it continues to go up, it wrecks the economy. Bad time. So we're desperate for this to come down, to get back down to the 2% level as quickly as possible. And like I've said on previous lives, I just hope that the people that we have in government, be it through the next election or not, are, I guess, competent enough to get it right. Because if they don't, we're all going to suffer. Someone's just saying here, not related to savings accounts, but do you personally think we are currently in a bubble with the whole AI fanaticism? Really interesting question. I actually was speaking to someone about this today. I had a coaching call this morning. We're talking about AI. Look, I think whenever you look at the tech sector specifically, there are always instances where a move in technology facilitates some kind of spike. Now, with AI specifically, it's currently unregulated. There's not a lot of legislation around it right now. And I think that once the full potential and the full range of applications come to light around how far you can push and use AI, I think we'll start to see regulation and legislation coming in, which will kind of reduce and try and control how much of an impact it can have. Because I don't know about you, mate. Look, I've watched Terminator, and call me like being paranoid, but I do think that, if you don't put the cap on something like this, you give it access freely to the internet without any real remits of control, it's scary what the potential consequences could be. I read a paper last year. There was a group of scientists in America. They developed this AI model, and they got it to kind of like communicate. And as it was developing and as it was growing and improving and becoming more intelligent, the coding language it started to modify the coding language that it was written in, to the point that the guys who actually developed it didn't actually understand the language anymore, didn't understand what it was doing. They had to shut it down because they were like, okay, this thing, you're teaching something to learn and be smarter than humans. So I think there's issues there. So is there a bubble? I think so. However, with that being said, I think when you go back to the fundamentals, the basics, right? Because it's not about, we're seeing X amount of growth in the tech sector because of AI. You're seeing growth in specific companies. So when you think about, you strip it all away and you start asking the fundamental questions, right? How is AI built? How is it implemented? What are the companies that are integral to its growth? You're going to hear companies like NVIDIA, chip companies, come up. And I think investments into those companies potentially protect you from a bubble potentially bursting, because NVIDIA just basically produces chips that will go into aiding the development and the progression of AI and its applications. And I think investing in those kind of companies specifically, I mean, the likes of ChatGPT, I mean, you can't invest in that right now, but Alphabet, Google, Microsoft, Amazon, investing in those kind of companies who have the ability to access these technologies that currently aren't available on the public listed markets for the likes of you and I, retail investors, investing into those companies makes sense. And so when you look at it from that point of view, investing in those companies because they are income generating on their own, you insulate yourself a little bit more from a potential bubble being burst because you actually invest in tangible companies that actually make something and earn money. Those are my thoughts anyway. Someone's just saying here, Tesco Bank has a 5.4% rate. That's a really, really good one. Is that instant access or a fixed term? I'll be interested to know. If that's instant access, that's brilliant. That's really, really good. Interesting. Okay. Nathan's saying here the NatWest has a regular saver at 6%. Great rate, but max is £150 per month. Yeah. That's what they do with a lot of these regular savers. They will limit how much you can pay in, so they can at least estimate how much of a payout they're going to have to give based on the number of customers that come in. So they're working scenarios here, right? If we get 1,000 customers all paying in a maximum of £3,000 and the rate is this is what we have to pay out. And because obviously they're taking your money and fractional banking and lending that out, they're able to key that into their profitability margins, all kinds of stuff. So all of this stuff is done intentionally, and they have actuaries working these numbers day and night. They know exactly what's going on. Guns here saying, please can you explain, if you can, the different savings account NatWest have at the moment, and if possible, recommend one, please. I don't know what savings accounts NatWest have without actually looking at NatWest specifically right now to be able to give you a response to that. But off the bat, they'll have instant access, they'll probably have a regular saver, and they might have a fixed rate savings account as well. With a fixed rate account, you'll have a guaranteed rate of return. It might be for 12 months, like I've already explained here. The benefit of that is it might be 5%. You know what you're going to get. So you put £1,000 in there, you're going to get 5% return. Great. But if interest rates go up, then you're stuck with your 5%. You can't also access a fixed rate within the term. So you're locking that money away. If it's a notice account, you have to give notice, although sometimes you can break the notice and actually pay a penalty for the amount of notice you had to give in the first place to access the money. Then instant access is instant access. In terms of which one you should get is all about your personal circumstances. I can't recommend that you go for a fixed rate, a notice, or an instant access without knowing more about you. So I can't recommend which one you should pick. I think whenever you're looking at these kind of decisions, you need to fully understand where you're at. Can you afford to lock your money away for 12 months in a fixed rate? Do you need access to the money within, say, a 90-day period? Do you need it on instant access? The answer to those questions should tell you which one you go for. Just scanning here. More winners on premium bonds. What? Premium bonds got me £850 this month. Only nil month for me was Feb. Always something since. Think max is 1 million, 100,000, 50k. Then you've got the other smaller wins as well. You got like 200 quid or 50 quid or something like that, 25 quid. Got 850 quid. Listen, so when you put it in that context, really, that's a pretty good return. And again, you've got to be willing to kind of be happy with the fact that you might win some months, you might not win some months. But there are two people here. One person who's got 600 quid this year, another person who's got 850 quid this year. Now, I don't know how much money you have in there. I would possibly argue that you've got a large amount of money in there that gives you more entries so that you're in the draw and you've got a higher propensity of being picked. But still, that's by the by. Even if you had 10 grand and you're getting 850 quid, that's still a pretty good return. I mean, it's an awesome return, really. So, there's something to be said for premium bonds there, and it's tax-free. I have 25k in premium bonds put away to pay TGT in January 25. Won £150 in the first month, July. In the first month. There we go. More tickets, more entries. So, when you start looking at it that way, you can't knock it. I think it's really, really good. Leandro, thank you very much for the reminder on this. If you haven't done so already, could you please smash the like button? And there we go. I've just seen we've got 81 people, 75 people on here at the minute on the screen that I'm looking at. We've got 41 likes. That's a pretty good ratio. If we can get that up to like 50, 55, that would be amazing. But thank you so much, Leandro, for the reminder on this. Disgruntled of London. Let's have a look at what you're saying. You're saying my experience of NSI premium bonds has been okay and safe. Over the last 3 years, I've had an average annual return of 3.1% on single block of 50 grand bonds. Very, very nice. So there's a lot of people here saying that NSI premium bonds are very, very well worth it. So, Gons, you've explained it well. Thank you very much. Thank you very much, sir. Let's see what else we got here. Yeah, a Matt just kind of encapsulates it here. It's tax-free, but there is no guarantee of winning, which is why I said you've kind of got to be okay with that game of chance. Like, you might get it, you might not get it, but if you do, you could be laughing, right? And obviously, the more money you have in there, the more entries you get, so the higher the propensity that you actually win a prize. All right, guys. There is one thing before I kind of like round this off. On the live yesterday, I asked people how confident they are about, dealing with interest rate rises and the increase that generally people are going to be experiencing. 51% of people said they weren't confident at all. And so whilst I will be doing kind of like maybe a finance clinic on Sunday evening, so again, if you're not subscribed, smash the like button, subscribe, and also hit the notification bell, because when I schedule it over the weekend, you'll get the notification that I've scheduled it. You'll also be informed of what time it is going to be on Sunday. It's probably going to be around about 8 o'clock, purely because I have a meeting with my accountability group at 7. So we're going to have a little bit of a catch up. But outside of the finance clinic, one thing that I'm thinking of doing is maybe running kind of like a workshop externally away from YouTube. And what I'll do within that workshop is I will run through with people, all the attendees, scenarios to try and maybe streamline finances a little bit more. And we'll talk a little bit about debt consolidation. We'll talk about a number of things, but there will be maybe 3 or 4 categories, and we'll deep dive into those, what to do, what to look for, maybe have a look at some deals, how to actually carry them through. But we'll do it in a workshop setting. So in a workshop setting, it will be maybe I might do it within StreamYard because people can join, or I might do it within Zoom, maybe something like that. It will be ticketed though, because I'm going to have to put time and effort into actually planning this. If I can, I will try and get some providers along, maybe Step Change, maybe perhaps on the debt side to offer some more kind of tips beyond what I would generally recommend. Normally when you're getting help with debt, you need to be a registered debt provider, and Step Change are that. I'm not. So I might try and put some providers along for it. But once I've decided what I'm going to do, when it's going to be, I will then let you guys know. And if you did want to get a ticket, definitely get a ticket. And we'll spend like maybe about an hour, maybe 90 minutes or so, really going through some different strategies to help people streamline. And we might deep dive a little bit more into kind of like savings and maybe even investments as well, how to really maximize and make it as tight and as tax efficient as possible. So that will be coming down the track. There is something going on, and maybe I need to do a different chat about this. There's something going on at the moment with people trying to repay their Help to Buy. It's actually scary. I mean, I've had messages from people who are just besides themselves right now. So much so that I'll be on Radio 4, fingers crossed, on Monday to talk about this, because this needs to get national traction. And it's particularly bad news for people who are trying to pay off their Help to Buy loan and cannot get their redemption figures. And because they can't get the redemption figures, some people are in danger of coming off a low fixed rate in the 1-2% to going onto their standard variable rate at 7.99%. I've been speaking to someone who's in that same position, who is going to go onto a standard variable rate if they cannot get this fixed. And the increase in the mortgage payments is £850 a month. So I guess I have an ask here. If you know anyone with a Help to Buy loan, equity loan on their mortgage, and they're trying to pay it back, can you please get them to message me on Instagram? Because this is a huge, huge concern. The government has dropped the ball on this big time, and we need to get it in the media, and that's going to start on Monday. So if you do know anyone who has a Help to Buy equity loan, ask them if they're looking to pay it off and they're in the process of doing it right now, and ask them if they're struggling to get into contact with me, because I need to hear from as many people as possible. Radio 4 is great, but it needs to be on like proper news. And that's my push at this point in time. But anyway, thank you so much for watching this. I appreciate you. I will probably, what's today? Today is Friday. So I'm probably going to see you again Sunday evening for the finance clinic. But in the meantime, please do share this video if you know someone who might benefit from this. And again, please smash the like button. It really does help. I know it takes 1 second and people get tired of me asking, but trust me, it really does help in terms of the YouTube algorithm recommending this video, recommending this video for other people who may benefit from this topic as well. And again, if you've not subscribed, we're at 41,820. Really want to get that to 850 really over the next few weeks. If you've not subscribed and you enjoyed this, or you've watched this on the replay, please consider subscribing.
Yeah, surprise, a little different than you're used to. Yeah. Dropping these bars on YouTube, knowledge I introduce you. Yeah. We chasing this money like it's the prize, it's the voodoo. Fugazi, it's just a lie we buying into. We need some cars on deck. Get the rollies, get the Moe, all the Mars on deck. We got the traders, got the picture with the Bentley in Dubai. Are you dripping in designer looking fly? On the bombardier, sipping on the wine. Broke man, we broke. Where's the fun in being broke? Stocks and bonds get you yo. That's what I'm teaching these folks. I see that smoke, see them choke. Getting coke. While I'm researching these stocks, buying coke. 20 months on the channel, million people taking note. I got a warrant for Buffet. I'm coming for his vote.